Fox Business Network studios in New York City, this is Opening Bell with Maria Bartiromo.
Good Monday morning to you. Welcome to the Opening Bell on the Fox Business Network. We're expecting a higher opening. We've got the futures turning higher on the M&A action this morning. This ahead of what is going to be a very important week for the economy and the markets. It is what you need to know this morning. And we kick things off with pending home sales today at 10 a.m. Eastern and the Dallas Federal Reserve survey for the month of July. Dallas Fed President Richard Fisher with an op-ed in the Journal today calling for the Federal Reserve to shrink its balance sheet. The Fed, of course, begins a two-day meeting tomorrow. We also have more housing data with the Case-Shiller report, and we'll get the latest reading on consumer confidence. Then it is a huge day on Wednesday. The first reading of the second quarter GDP is out. This coming off of that awful first quarter report. Remember, we had a 2.9% contraction in the first quarter, so we are all focused on that second quarter first reading of the GDP. The Fed delivers its latest decision on interest rates as we get the ADP report on private payrolls. We are expecting the Fed, by the way, to cut the stimulus further to now $25 billion a month. We'll hear that on Wednesday. And the private payrolls report sets us up for the July jobs report from the Labor Department. That, of course, coming on Friday. This morning, we're also watching the latest on the race to acquire Time Warner by Fox. Our colleagues Amal Sharma at the Wall Street Journal reporting today that 21st Century Fox, the parent of the Fox Business Network, is set to offer Time Warner shareholders a voice on the board with a board seat. The stock in Fox's previous offer was non-voting shares. We'll talk about all of this with my guest this hour. Jeff Taylor is with me. He's Managing Director of Digital Risk. Anastasia Amoroso is with me. She is the Global Market Strategist with JPMorgan Asset Management. But first, let's get to the top stories of the day this Monday. The packed week of data ahead from second quarter GDP to the unemployment numbers to the FOMC meeting. A lot to digest and anticipate. Joining me to help break it all down are my contributors for the hour. Jeff Taylor is Managing Director of Digital Risk, and Anastasia Amoroso is Global Market Strategist at JPMorgan Asset Management. Good to see you both. Thank you so much for joining us. So before we get to the economic data of the week, which of course is so important and is probably going to set the tone for markets this week, let's talk geopolitics for a second. Anastasia, the markets have not reacted to any of this.
No, they have not, because on the surface, there's not a whole lot of risks emanating from geopolitics, because you look at Israel, you look at Ukraine, you look at Iraq, and you couple all those things together, and you come up with about GDP less than 1% of global GDP is what we're talking about when we talk about those countries. So on the surface, I think that's one of the reasons why the markets have not reacted. Also, oil prices have not moved significantly higher, and the financial linkages to those three countries are not that great. So that's why the markets are now reacting, except for in isolated pockets, of course. But I think we do need to pay attention to geopolitics, because the longer it goes, the more prolonged the conflict becomes, the more damaging the economic consequences may be.
And given Europe's, sort of reliance on oil and gas from Russia, Europe's economy certainly is very vulnerable, and that's our largest trading partner.
Europe is very much exposed. You're absolutely right. So, it's a bit of a domino effect. If we start with Russia and we go to Europe, eventually the U.S. can get impacted as well. That's why I think the Europeans are treading so lightly on the sanctions front, because Europe has nothing to gain from a weaker Russia. It has a lot to lose.
That's absolutely right. And Jeff, what's more important to you? Is it these geopolitical unknowns out there, or is it the economic data this week that's going to really give us a window into how the U.S. is doing?
Yeah, for me, no, it's the economic data coming this week. I mean, we're going to see what the Fed's going to go ahead and do this week. Unemployment is starting to creep down to that 6% number, and the Fed had previously indicated they may start to raise rates. If that happened, I don't think this is the time to do it right now. I think right now we're still in a huge confidence game, especially as it relates to the housing market right now. We're going to expect for housing sales to be down significantly this month from last month. And what's it going to take for banks to start lending outside that perfect credit box? And what's it going to take for these millennials to start getting into the housing market and actually buy a house, taking advantage of the historically low interest rates?
Why has housing been so choppy, Jeff? I mean, you're expecting tough numbers today at 10 a.m. Is that priced into the market?
I don't know if it's priced into the market. I really think it's a median household income. If you look for 2007, the median household income was $55,000. Today it's $51,000. That's only an 8% drop, but that 8% has a huge impact on people's discretionary income, where they're going to spend those dollars and make big ticket purchases like houses, cars, etc. That
makes a lot of sense. All right, so the GDP data Wednesday, Anastasia, what's your take on that? What's going to be the most influential number this week, you think?
I think GDP and payrolls, of course, are the two that will be on the docket for this week. I think GDP second quarter, we should see quite a material rebound from the first quarter because everything that possibly could have gone wrong in the first quarter just about did.
Yeah.
Whether it's inventory drawdowns, whether it's the overestimates of the healthcare spending
Plus
that
the
did
weather.
not pan out, the weather, not to mention the weather. So we should really see a pickup in the second quarter because all of the evidence has been adding up to much better new orders, much better labor market trends. So that should absolutely support the number. If we don't see 3%, that could be another story.
Is that right? So I'm glad you said 3% because a lot of people that I've been speaking with are expecting a 2.9% number, 3% print. How do you go from 2.9% contraction to 2.9% growth, Jeff? Is that doable?
Yeah, I think the Q1 was such an anomaly. It was such an outlier that I think we're going to see closer to 3%, but that kind of puts us flat for the year again. So really, where are consumers going to be spending their money? That's going to be a big tell sign going forward.
So you think that's priced in, Anastasia, 2.9% growth Wednesday? I mean, if we don't get that.
I think 3% is about consensus. So I mean, estimates really range, and I think there's some estimates as high as 3.5%, but we really have to see consumers come back. We really have to see the manufacturing activity be really strong. We probably have to see some inventory built to support the notion that the economy is quite strong going into the second half. I think all of the evidence is there. There's a bit of a preponderance of evidence there because the labor market has established a trend, which gets us to the Friday's payroll number. We're starting to see very consistent 220, 250,000 a month prints, and that is very good for eventually the median income.
You know, I think it's good though, but what worries me about the labor numbers is that's 200,000, but there's still so much slack in that. I mean, it's 100,000 one way or another, depending upon who you ask. So are they just not being reported anymore? Are they still out of work? So I agree, but when I look at the hourly wage rate, and that's still not rising, it's going down. Those things still give me a lot of pause right now as far as healthy economy second half of the year.
Everybody's watching wages, and they really haven't moved much. I mean, that's sort of the Fed's gauge of inflation. All right, guys, stick around. Got to get your take on the M&A action that we're seeing this morning as well. We're just about 20 minutes away from the opening bell. We'll continue our conversation with Anastasia and Jeff on the state of the housing sector, economy, and the market straight ahead. Plus, more deals on Wall Street this Monday morning. On top of the dollar store deal, Zillow acquiring Trulia in an all-stock deal. Nicole Petalides is on the floor of the New York Stock Exchange looking at that one. Over to you, Nick.
Hey, good morning, Maria. Good Monday morning, everybody. Everybody's piling in here. You see futures are looking higher. We had a down week last week. Just had a chat with Ben Willis, and he was noting that the corrections that we've been seeing have been, or at least in part, slightly in sectors, right? So we first saw the biotechs pulling back, then we saw social media pulling back. We've seen semiconductors coming under pressure, financials to a certain extent, but he still says he remains bullish. That being said here, I wanted to talk about, and part of the reason is M&A action. We've talked about mergers and acquisitions. Let's focus on Zillow and Trulia today. Last week, we got a touch of this news. It is, in fact, true. We have the two real estate companies, website companies, tying up. Zillow buying its smaller rival, Trulia. It's a $3.5 billion deal in stock, both of which have gotten a pop recently. But I have to tell you, Maria, as we see Zillow, they are closed at 158 and change. Zillow, in the middle of July, was $123. So it really has had a leg up and then another leg up late last week. So we've been watching that. And same with Trulia. Trulia on the 17th was $38 and closed on Friday at $56. So the two companies really have been running up over the last week and a half. Back to you.
All right, Nick, we'll be watching those. Thanks so much. I'm back with Anastasia and Jeff. And Jeff, what does the Trulia Zillow deal mean for the housing market in your view? You cover real estate among others in terms of specialties.
And for me, I look, it's consolidation. You have two of the biggest leaders out there sort of in the internet appraisal space looking for value. They've come in together, so they're basically guarding against any new entrants coming into the marketplace being disruptive and sort of taking away their market share. I think it's a smart move, and ultimately those platforms are very complementary to each other, so you're going to have that many more users available immediately.
So you need scale in this business?
You need scale, absolutely.
Yeah. And that's what this gives them.
Go big or go home.
Yeah, go big or go home. Anastasia, what about all these deals that we're seeing? $2 trillion in M&A action this year, more than $2 trillion, by the way, globally in mergers and acquisitions. Today, you see the Dollar Tree Family Dollar deal. What's your take on all this deal flow?
I think it's absolutely absolutely telling the market, telling investors that we do have a much greater degree of confidence, much better economic backdrop in order to do those deals. Just like we talk about CapEx, we can talk about M&A and say that companies don't look to either take on debt levels or deploy their cash when they're not quite sure about what the future stream of cash flow might be. So the fact that we're seeing such a tremendous pickup in activity is a testament to an economic expansion. Maybe it's up 3%, maybe it's still lackluster, but it's absolutely broadening and unfolding.
Yeah, it makes a lot of sense, confidence, and that's what we want to see. Well, the corporate sector is probably the best part of this recovery. You know, $2 trillion, $3 trillion of cash on balance sheets, so sure, confidence, I totally see that.
It's the one that you can't argue against, right? Because we debate all the labor market slack, we debate the medium incomes, because, you know, it's very difficult to make a strong case that the consumer is fully back to where it was before 2007. Banking sector, once again, much better balance sheets, but we know the other headwinds that the banks are facing. But yes, corporations are definitely on the winning streak here.
What do you think, Jeff?
Yeah, they really are. If you look at, obviously with interest rates so low, you've had massive stock buyback programs for a lot of these companies, and they're deploying cheap capital to go ahead and maybe potentially reach a little bit to make strategic acquisitions right now, which make a lot of sense in the marketplace. So
how do you want to invest based on all of this? Based on an economy in the U.S. that seems to be getting better. We'll get total confirmation this week in a number of areas, certainly with the GDP, if we see that kind of a rebound, as well as all this deal flow.
Yeah, so right now I'm looking at large cap equities, those who can really kind of grow their dividends for the long term, and I'm basically saying that those equities over time are going to be smart buys.
And you know, the dividend play and the buyback play, that's been the case for a while. Companies spending money on dividends, spending money on buyback plans, but are you expecting CapEx to sort of be part of this second half of the year, where companies will start spending some of that trillions that they've got on balance sheets to actually invest in equipment?
Yeah, we truly are expecting CapEx to pick up, and we're starting to see that. For example, when we look at the second quarter's earnings season, we're starting to see more and more companies guide towards higher CapEx. And we're also looking at some of the small and medium-sized businesses surveys, and once again, CapEx expectations are starting to pick up. So when I think about the investment landscape, it's not necessarily who is deploying cash to that CapEx, but it's who actually benefits from other companies deploying their corporate cash. So it's industries such as energy, such as some parts of materials, such as industrials, and of course, infotech, not to forget, that stand to benefit.
You know, also you look at the financial sector right now, banks have a lot of money in balance sheet. Typical loan to deposit ratios are at 97%. Currently they're at 77%. So they're basically sitting, waiting to deploy those cash in areas that make them the highest returns in the future. They're in good position.
So in terms of sectors, do you agree? I mean, energy, certainly I could see that. I mean, investment in drilling and services around this energy story in the U.S. makes perfect sense. IT as well. Any other areas that are beneficiaries?
Yeah, I like high tech, honestly. I really do. If you look at the acquisitions Oracle's been doing, they're buying smart companies, strong earnings, and they're positioning themselves into the cloud and for the future right now. So I think that's a big area. Also in the high tech sector, you're seeing the venture capitalists that haven't been as active in the last 14 years as they are right now, because they're realizing, you know, a bet could be as disruptive as, look at Instagram. My guy, when that first came out, I thought this is a 1 in 1,000. Look at where it is today. So I think high tech's an area.
So VCs are buying private companies, private valuations. Are they getting away from them?
Yeah, I think private valuations right now in general are still within reason, but there's a couple of examples where you look at like a WhatsApp and I'm like, okay, wait a minute.
Yeah, what is up with that?
You know, I get the 400 million users, $20 million in revenues. To that one, I don't really get, but you look at the one today, Dollar Tree, it makes a lot of sense to me because it's expanding its footprint. It's going to about 18,000 locations across the U.S., which is actually bigger than Walmart. Now, granted, it's only $18 billion in revenue, Walmart 300, but with those locations, it gives it the ability to go ahead and reinvent itself closer to consumer, add additional products, and strengthen its play.
So you have to believe, even though this is a much smaller revenue base, Walmart is watching this deal and is noticing. I mean, yes, $300 billion in sales versus $18 billion in sales, but again, scale is going to be really what you need to do in this business.
Yeah, scale is critical, and also scale allows you to get better pricing from your suppliers right now. So Walmart commands such a price from their suppliers. This deal actually will allow this company to get better pricing from suppliers, ultimately hit healthier to the bottom line.
That's the bottom line. It's true, the strength that they can get from suppliers. All right, stick around, guys. Got to talk to you about the market open. We're just about 10 minutes away from the open. Welcome back. Just a few minutes away from the opening bell. The Dow coming off of a triple-digit decline on Friday, even as the S&P 500 is hovering near a record high. I'm back with Jeff Taylor, Anastasia Amoroso. How does this market feel to the both of you? I mean, are you seeing the fact that we keep getting record after record in the S&P 500? Are you feeling like valuations are getting stretched or no?
I think it actually is a story of differentiation there, because if we look at some of the traditional defensive yield sectors, such as staples, such as telecoms, such as healthcare and utilities, yes, valuations are getting stretched because a lot of the upside came from earnings, but a lot actually came from valuations. But if you look at some of the cyclical growers, such as energy, such as materials, you actually have not seen a whole lot of multiple expansion. So that's why I continue to stress those areas, because not only are they the areas where top line growth should come from, but they also have the most opportunity for multiple expansion.
All right, so you really have to be selective in terms of allocating various sectors.
You really do.
What do you think, Jeff?
And the two I'm still focusing on the most are, again, financials and technology. Again, with financials, I just think the perfect position with all the cash on balance sheet, no matter what asset class, to go ahead and make moves as they see fit. So that's one. Two, technology. And a perfect example of this might be Microsoft. This is a company right now, I like what the new leadership is doing. It's come back in, restructuring 18,000 jobs, has a huge cash war chest. So now as it heads into the marketplace on the devices play, if it can go ahead and execute, you could really see a tremendous story for this company over the next 24 months, not to mention it's already up 20% this year.
Yeah, I mean, it's done well on the anticipation that Satya Nadella is going to be making changes and you know, getting the juice back into the company. Yeah. So you would still buy it, though, at these levels? I buy it at these levels because really he's just begun. So it's all got to come down to, as you said, execution. Can he execute on the vision? Can they go ahead and grab the market share? So right now, that's sort of the stock that I'm following. Probably, again, it's a longer-term play, but I'm very excited about it. You know, I never want to write off the month of August because the last couple of Augusts have been so busy. You would think that volume would slow down, although we've had, you know, quiet volume for a while now. But things are very busy.
I think that's right. You're also moving closer and closer to October, which I think is a really key Fed meeting for the market participants, because we know that QE most likely ends in October. So the conversation is really going to start shifting to, is there enough wage growth? Is there enough inflation to finally justify raising that short-term rate? So yes, markets will be paying attention to the payrolls numbers and all the other data points throughout August.
But going into October, obviously that's the month because the Fed's going to stop tapering there. You mentioned Microsoft. Is Microsoft the kind of company that has pricing power in an environment where we're not seeing a lot of it as we wait and watch for inflation?
Yeah, I think it does have pricing power in the market right now, but I think that the bigger story is going to be, as far as what we're looking for in October for me, it's going to be as the Fed gets out of QE. So much of that money right now is being spent on the mortgage-backed securities that it's purchasing. If we don't start to see an increase in wage growth right now hourly, how are we going to get the consumers back into the marketplace? They're actually going to start picking up these mortgage loans and start buying back into the housing sector. So the pricing power and really moving forward there is going to be very important.
Are you worried about this coming out of this experiment? We've never done something like this. QE 1, 2, 3, and then exiting with this huge $4 trillion balance sheet that the Fed has.
Yeah, I really kind of am, because if interest rates kind of spike overnight, all of a sudden you're going to have people sort of playing the waiting game saying, okay, well, should I buy today or tomorrow, because rates have risen. So it has to be a really kind of a seamless transition, and that's got to be messaged correctly and pulled off seamlessly.
Yeah. But I think that's exactly what the Fed is trying to accomplish. Yes, it is an experiment. It is an unprecedented one. But I think they're developing more and more tools to help them design, engineer, execute the smooth transition. There's the primary dealer survey. There's now also an investor survey. So they're really gauging market reaction to every speech, to every communication. So the objective is to not shock the markets with a 50 basis point, rate hike, but to really get us to where it's fully priced in.
Yeah, no, you're right. I mean, becoming much more transparent as well. All right, guys, stick around. The open has sounded. Stocks opening mix. We want to check in with Nicole Petalides on the floor of the New York Stock Exchange with the opening prices. Over to you, Nick.
Hey, good morning, Maria. Morning, everybody. It's Monday. Back to work here. We see the Dow down about 14 points, sitting at 16,947. The S&P just fractionally lower, and the Nasdaq fractionally higher. The Russell squeezing out a fractional gain as well. So you can see that the stories are going to be in stocks in particular. Let's talk about the M&A activity. I know Liz McDonald's been hitting a lot of the Dollar Tree Family Dollar stuff. We're looking at Zillow and Trulia as well. We're watching Zillow to the downside, down 3%. Trulia up 13%, new high there. This is on a $3.5 billion deal in stock. Also take a look at Tyson Foods, up 3.25%, and Nissan Motor up 3.5%. Both companies coming out with news. Tyson had better profits. That was some good news there. Don't forget, they're preparing to close their deal with Hillshire, and Nissan coming out with better than expected profits there. They did very well abroad in China, in North America. It offset what they saw in Japan. They even did well in Europe. And take a look at some of these solar stocks, all down arrows to the tune of 2 and 3%. Jiko Solar down 3%. This is on news that the U.S. sent some anti-dumping tariffs, and that's because some of these solar products are being sold too cheaply in the U.S. Back to you.
All right, Nicole, thank you. Sandra Smith, what's moving on the NASDAQ?
Hey, Maria, we're certainly watching Dollar Tree buying Family Dollar for $8.5 billion. Look at that. It's the biggest gainer in the NASDAQ out of the gate up 8.5%. A big move already that we're seeing there. Also, Wynn Resorts, Vodafone, Express Scripts, Marriott, and Gilead Sciences rounding out your top 10 biggest gainers in the NASDAQ in the first couple minutes of trading. Take note that the NASDAQ did open to the upside. It was the sole gainer of the major averages. The major averages mostly to the downside. The NASDAQ holding on just a slight gain there, but definitely getting a boost from that dollar store deal getting done. Maria, back to you.
All right, Sandra, thank you so much. Meanwhile, it is another huge week for IPOs, capping off one of the busiest months for offerings in more than a decade. Liz McDonald watching the IPO story. She's in the Business Center. Liz.
Yeah, that's right, Maria. Monster week for IPOs. 23 IPOs expected this week, 40 for the month of July rather. We haven't seen that level of IPO activity since 1999 or 2000. Last time we really saw this real severe one-week spike was in 2004. Also, we're watching the number of IPOs, 161 IPOs so far this year, raising $36 billion. The one that the Wall Street's talking about is GE spinning off its finance arm into a company called Synchrony. That's an expected $3.1 billion deal. That's one of the biggest of its kind in 2 years. Also, Virgin America, Richard Branson's Virgin America filing a registration for an IPO as well. Back to you, Maria.
All right, thank you so much, Liz. You know, a lot of these companies, I guess, want to get through this window. Jeff Taylor, Anastasia Amoroso with me ahead of Alibaba before the window closes. It's still open in terms of IPOs, right?
Yeah,
the deals have been doing well.
Yeah, that's right. I think there's probably a little bit more to this window, but I think as long, this is probably the most investor appetite that arguably we might see for some time, because we have a lot of certainty in the market now, and we don't have the Fed that is raising the short-term rates. But I think as you go into next year and the year after that, that window does start to close.
Yeah,
so I think that's right.
I think it closes after Alibaba probably, unless Alibaba comes in the fall. Which may very well happen. That's what they said.
And you know, something like Virgin American specifically, would you have thought really another airline would be going public in the next 5 years, all consolidation?
Yeah, Virgin America, amazing.
Yeah, you really wouldn't. But you look at that, and I think it's a testament to how he's sort of reinventing that airline, how it differentiates between others. So again, it's you know, hats off to Richard.
What's your take on emerging markets right now? Emerging markets, I guess, have been seeing a bit of an uptick in terms of money flows moving in there, but it's very much a mixed and spotty performance. And I know you can't look at the emerging markets in one, you know, one brick anymore.
Yeah, it's definitely a mixed bag, and sometimes it's time to break apart the bricks. Obviously, the Russia brick is not cooperating very much at this moment, but I think if you do look outside of that, and if you do look, for example, to Asia Pacific, Asia Pacific and Taiwan in particular is very much geared to the global economic growth because of the export channel. So what we're starting to see is that since we had this sort of benign interest rate environment, rates have not really been rising much this year, as we know. There's not a pressure to tighten policy in Asia Pacific as a response, and you have companies that are benefiting from better export orders. So we saw the Taiwan new export orders number last week, and it was exceptional. So all of that is in anticipation, I think, to a very strong pipeline that we'll see in tech new products headed into the fall.
All right, so Asia Pacific looks good. What about Japan? You guys like Japan?
You know, Japan, I think I do right now, but I think to point earlier is right now what you're seeing overseas, especially in Asia, is the fact that if you can have the products produced at a lower price, what they can, and ship them back to the U.S., that's always going to be an attractive value proposition. So as far as emerging market goes, globally, you have to be, I think, more regionally specific, but I think Asia is very attractive.
Asia's attractive. Europe, we talked about Europe being, you know, very reliant on what's going on in Russia. Would you buy Europe?
I think Europe is a buying opportunity. So yes, sure, there is a risk that higher energy prices and less business with Russia could lead to a deterioration of the economic cycle there. But I think there's such a symbiotic relationship between Russia and Europe. And yes, there may be an escalation of sanctions in the near term. But over the long term, I think the logic that the countries are so interconnected business-wise and energy-wise, it has to prevail. So it is a risk that is acknowledged by Mario Draghi. But nevertheless, I do believe confidence, I do believe logic will prevail there. So, and because of that, if we look at PMIs, for example, the manufacturing PMIs in Europe, they have ticked up quite a bit last week again. So this is an example of all these good data points, all these good improving fundamentals that get lost in the geopolitical shuffle.
Right.
So
that's right.
recovery there is continuing.
Jeff, any international ideas?
Yes, I'm still kind of long the large cap international stocks right now, especially in Europe, and there's still a nice buying opportunity as real estate. There's still a lot of undervalued stocks and bonds in real estate in different parts of Europe right now that are still very attractive, and that's where you're seeing a lot of smart money like hedge funds go to deploy assets.
All right, real estate international. Great to have you both on the program today. Thank you so much.
Thank you so much for
Jeff
having us.
Taylor of Digital Risk and Anastasia Amoroso of JP Morgan Asset Management. Come back soon. We'll see you soon. Have a great day.